Welcome today to Investing 102, Risks and Rewards. This is our second in our two webinar series for February on investing. My name is Andrea Pellegrini, and I run the Student Money Management Center out of University Bursar for the entire University of Illinois system. And I'm joined today by Erin and Ann. Erin, would you like to introduce yourself?
Yes, thank you so much for having us, Andrea. My name is Erin Scheithe. I'm currently serving as the Acting Assistant Director of Investor Education and Outreach in the DC headquarters office of the U.S. Securities and Exchange Commission. And I will turn it over to my colleague, Anne, to introduce herself.
Thanks, Erin and Andrea. My name is Ann McKinley. I'm an acting associate director in the Division of Enforcement of the SEC. I am based out of our Chicago regional office, and my day-to-day work involves supervising the investigation and litigation of securities law violations. But I love it when I get to speak to people about how to protect themselves. So before we get started, we do need to give a disclaimer before we speak. Erin and I are appearing in our official capacities with the SEC, but our views today do not necessarily represent the views of any of the individual commissioners, the commission itself, or anyone else on the SEC staff. We also are not providing legal advice or investment advice today. Instead, we're talking about general principles of sound investing and avoiding fraud.
Thank you so much, Anne. And in general, any of the Get Savvy series are intended as educational and not as advice. So keep that in mind, even when you're listening to our recordings. So we are going to launch a poll that gives us a little bit of information about who's joining us today. I just launched it. It has some information about kind of knowing what age range you're in, whether you're a student or an employee or a parent, maybe. Maybe you're retired and you're looking how to optimize your current investments. We also want to know which University of Illinois system university that you are associated with. I serve Urbana, Chicago, and Springfield, and a lot of the partner organizations that we work with at each campus or each university likes to know how successful we were with promoting some of these and working together on some of these outreach events. And then we also have gender and race and ethnicity. So there are lots of people that are students, but there are more full-time employees. You may be both. I am both. We have basically all the age ranges identified in here. And we have lots of people from UIC again. Last time we also had a bunch of UIC folks. So in the interest of time, I'm going to go ahead and end the poll. I'll share the results just real quickly so you can see kind of who is joining us. That also helps us modify some of the way that we talk about some statistics and some of the concepts today, which might be different depending on where you are in your longer term career goals and savings goals or investing goals. So I'll stop sharing that. And let's talk about some learning objectives. So we kind of focused on the very basic kind of conceptual aspects of investing during Investing 101, and Investing 102 is going to focus on understanding the risks involved with investing, identifying some strategies to help mitigate those risks. And we're also going to be describing some ways that fraud can derail some of the rewards of investing. And we're very lucky that Anne, who works in the trenches on that effort and regulation to help prevent those kinds of fraud and scams from happening or address them once they have happened, to share her expertise. So we also have another poll, but we want to kind of get an idea of what risks and rewards you think are associated with investing. So I just launched the poll, but if you're more comfortable or prefer, you can answer in the chat. So what types of risks do you think are associated with investing? And what types of rewards do you think are associated with investing? Since that's the name of our webinar today. All right, so there's a few people that have answered, and I didn't realize I couldn't monitor the actual responses live. So if anyone does want to put in the chat, we can read those off. We'll let you have a couple more seconds to respond. I know it's not a lot of time, and there's many different ways to describe risks and reward, but we have a lot to talk about today. All right, I'm going to go ahead and end the poll. So submit. I'm going to give you a few more seconds to submit. I'm going to go ahead and end the poll. Lots of people answered, but I'll stop sharing. And I'm going to hand it over to Erin to talk about understanding the risks of investing.
Yes, thank you so much. We're going to get started by talking a little bit about when you're investing, and because of the age range that I see, it's our hope, it's probably a likely reality that many of you are already investors. And so some of this may be a little bit of a renew or a review for you, but really anytime you engage in either leveling up your investment or your investment portfolio, or getting started with it, you'll know that the difference between saving and investing is that investing has risk associated with it. It is not a game. And there are a lot of things that we have to consider as we move forward. A lot of people are getting started with investing or kind of leveling up their investing by using kind of an app, a financial management app, sometimes they're using investment apps from different companies. You don't even need an investment advisor necessarily anymore to get into this world of investing. But do remember that it's not a game. A lot of these apps gamify things or share nudges like throwing confetti when you've made a trade, or sending you a push alert that says you haven't looked at your investments yet today, something like that. So keep that in mind and take care of your needs first. Do not invest money that you can't afford to lose. So similar with anything else that you might do in your financial life, you want to make sure that you're not using any of your federal financial aid funds, any of your tuition money. That's illegal, but also just only investing what you can afford to lose. When we look at this chart, one of the reasons why I really like this chart is it shows large stock performance in this country for about 100 years. And what you notice here there are a lot of ups. And are there a few downs? Absolutely. But there are far more ups than downs. So typically what stands out the most is that there's volatility here. Sometimes the wins are big wins. Sometimes the losses are big losses. In the late 1920s, there's that huge loss. That was the Great Depression. Again, this isn't a history class, but some of the times when you see these big losses are going to be times that you remember from your history lessons, are also periods of great economic change in our country, or periods of war or things like that. So keep that in mind as you go through. So this shows the volatility. The next chart here on the screen is a shorter timeline. We're going with 30 years instead of 100. But this shows you that despite the ups and downs that the stock market will naturally go through over a long period of time, overall, the trend is upward. So you'll see here that since the mid-90s, the stock market has generally been on an upward trajectory. There again were periods of volatility, periods where the stock market, the S&P 500, was trending downward, but it recovered each time and then some. So let's talk a little bit about some of the ways that investments can lose money, just because that is one of the risks here. A company's competitors are better than it is. Either the product is better, their marketing is better, either it's not as convenient for people to go to as it is to order something online, for example. Other ways are that consumers don't want to buy the product or service anymore. If you were a company making, house landline phones, for those of you old enough to remember what those are, and it seems like several of us on the call feel that way. But when you think about something like that, obviously that if you were investing in landline phones, you would have lost some money over the past couple of decades. Sometimes companies aren't managed well, or someone who's running the company is actually not honest or is doing some shady dealings. And for whatever reason, you must sell your investment when the market's down. So those are a few ways that investments can lose money. Another risk is what's considered buying on margin. So this is something that's typically not available to everyone, but this is when you are able to borrow money to buy shares of stocks. Now, when that happens, if the value drops, the broker could say to you, oh, listen, the stock purchase that you initiated on margin, it's lost value. And so I now need you to pay me what you borrowed to buy those shares. So that potential loss could be much more than your initial investment, and it's something to keep an eye out for. Usually, very few novice investors will do something as risky as buying on margin. Another element of risk is short selling. So a short sale generally involves the sale of a stock that you don't own. Short sellers believe that the price of the stock will fall, or they're seeking to hedge against a potential price volatility in securities that they own. If the price of the stock drops, short sellers buy the stock at the lower price and they can make a profit. And if the price of the stock rises, short sellers will actually incur a loss. So this kind of walks you through that example here. The caution here is that there's really no cap on a value of a stock going up. So the risk of losing money is, there's really no boundary to it. It's infinite. And then there are additional risks with short-term trading. So one of the things that we really teach in the Office of Investor Education and Assistance, where I work for the SEC, we go out and make presentations like this every day, every week, all kinds of different audiences. And we talk a lot about your investments are not they're not something to be juggled on a regular basis. They're not a crock pot where you set it and forget it either, though. So you don't want to do too much short-term trading because you may miss high returns on certain days. So the better idea, and what the Library of Congress found when they did a study, is that the best idea really is that you keep yourself in a somewhat passive state. Again, too much active trading is actually not the best way to achieve gains in investing. And that dives right into this next slide about the risks of timing the market. So again, this first little icon here describes that active trading generally results in underperforming the market. That's what that Library of Congress study showed, that the people who tried to beat the market actually underperformed. Because investors follow trends, they may overreact to good and bad market news. I don't know if you've noticed in the media that every time there's a major world event or different political drivers, you'll next have a follow-up story about how that has affected the stock market. So keep that in mind, that trying to pick individual stocks is sometimes a very tricky thing to do. It may leave you with not as much diversification as one would recommend, meaning you own just tech stocks right now or just pharmaceutical stocks right now, when really you should own a broad base of many different kinds of public companies. And then, as I mentioned on the previous slide, studies have shown that missing the best performing days of any time period can actually negatively impact your long-term returns. And then, like I mentioned, there are a couple of other kinds of risk associated. Geographic. So that's operational and emotional risks, things like energy prices, things like war, um, things that just cause general consumer anxiety or excitement, on the other hand, like the holiday shopping season tends to kind of have an impact on markets sometimes. Economic risks are the slowing of your economy, recession risks, that's certainly going to drive the stock market performance. And then different things like social media, even competition, leadership changes. If a CEO is ousted, that kind of thing can all have an influence. As can viral influences like social media and finfluencers. Consumer sentiment, meaning during the pandemic, we were all buying things online instead of going into actual stores. So the price of stock for companies that sold things online was increasing, and in-person stores that was decreasing. And then the media, as I mentioned as well, just how news stories are reported is certainly something to consider. And that kind of brings me to a question that I try to ask every audience when I speak, which is all about your money personality. A big piece of this risk and reward that we haven't touched on yet is something that only you can answer in your own situation. And that's, what is your personal risk tolerance? Are you a spender or a saver? Do you like to hoard your money in your savings account, and you want to make sure that it's there in case there's an emergency? Or do you like to see your money hanging up in your closet? It's one of my quotes from a movie. But what is your money personality? Are you going to be someone who's very intolerant of risk? That's something that happens to me a little bit. I definitely get nervous about putting my money at a significant risk. And so I tend to be a bit more conservative in my investing. So it's something to think about. And there are a lot of different ways to find out what your money personality is, what your risk tolerance is. And I believe Andrea is going to share a little bit about those in the handout that is provided after the presentation. And with that, I will turn it back over to you, Andrea.
Thank you so much, Erin. We've talked about money personalities and all the research that's done on money personalities a lot over the years within the Student Money Management Center. So we are going to make sure to include that in the follow-up email that gets sent out to all the registrants with this recording. But I want to talk specifically about some tools for investment strategies that can help you mitigate risk and even be more aware of your own money personality and risk tolerance. So with risk tolerance, this is something that we tend to talk about a lot in our investing education, but it varies from person to person and even across our lifespan. So your risk tolerance is a part of your overall money personality, and it contributes to your money habits and your financial decision making. And there is research out there that shows that younger adults and men tend to be a little more risky when it comes to investing, but that is just a trend and it may not describe you or your situation. But this quiz from the University of Missouri can help you identify what your own risk tolerance is if you haven't really thought about it before. And you shouldn't use it as a guide on how to approach investing, but rather something to inform how you approach investing or how you talk about your own goals or tendencies or anxieties when it comes to financial decision making, or if you seek out a financial professional to help you with your investment goals and your investment trends. So, in thinking about investment strategies, it's also important to think about what different investment tools have for different risks and the potential danger um, or the greater return that generally comes with a higher risk. So, this graph shows how savings tools and investment products move from a safe but lower return cash at the bottom left up to a riskier but higher return stocks at the upper right. So this graph is from the SEC, so we can thank Anne and Aaron for this. It shows, but also how lower risk products tend to be better for short-term goals, while higher risk with higher potential rewards are better for longer term goals. So that's a one way to kind of categorize the different types of investing and saving products that are out there if you're thinking about your maybe short-term, mid-term, and longer-term goals. When you're investing in stocks or mutual funds that have stocks, a diversified portfolio is one that would have stocks from a variety of business types, maybe in different sectors of the stock market, which we touched on a little bit in 101. You wouldn't want to invest in only one sector. For example, you don't want to put all your stock investments in aerospace. Because if for some reason the market value of stocks in that sector were to go down, your whole portfolio would be significantly impacted. So it's better to spread out the risk, so to speak. You want to invest in more than one company or industry, and investors can diversify automatically by buying mutual funds or ETFs. This lessens the impact of any one investment on your overall returns. And it can also help reduce business risk and market risk specifically. So, people also tend to diversify their investments across asset classes, which is called asset allocation. For example, some of their assets might be in stocks, some might be in bonds or real estate or cash, etc. And this also minimizes the risk against market swings and allows for changing your portfolio's volatility risk overall. So those are some things to think about when it comes to diversification and asset allocation. Another method that you can use to help kind of standardize your approach or be strategic in your approach is dollar cost averaging. This is when you invest the same dollar amount on a regular basis over an extended period of time. So since prices fluctuate, you'll end up investing the same dollar amount each time, but you'll get more shares when prices are down and fewer shares when prices are up. So this can help reduce market risk and exchange rate risk. And it also helps make your investing approach a more predictable and sustainable part of your overall budget or financial plan because you know you're investing the same amount, knowing that dollar cost averaging is going to help you reduce some of the market and exchange rate risks associated with investing in general. So automating is really important to your overall financial plan. We can also think about automation when it comes to investing. So it helps to do your saving and investing automatically. You can set it up with your financial institution to have money sent directly to a savings account or an investment account. And if you have an employer-sponsored defined contribution retirement plan, this automation is usually set up when you decide how much you're going to contribute to your retirement from your paycheck. And so this creates a habit of saving and allows the power of compounding interest to work for you over time. And so if you are automatically investing $75 a month, you could have over $5,000 saved after 5 years, over $12,000 after 10 years, and over $36,000 after 20 years, assuming a 7% rate of return. And of course, stock market returns can vary greatly every year, so keep that in mind. The other thing that we want to highlight is that no service is free. So it's important to pay attention to the fees that you're going to be charged. Actively managed funds tend to have higher fees than index funds, which are passively managed. And assuming, let's say, two investments have the same rate of return, the one with the lower fees will grow faster. And sometimes the fees are a little bit hard to find and compare. But luckily, that FINRA has a fund analyzer tool to help you compare fees for over 30,000 mutual funds and exchange traded funds, or ETFs. And then here's an example to emphasize how just a small difference in annual fees can make a big difference on a $100,000 portfolio over 20 years. So the blue line shows a 1/4 point annual fee. The red line shows in the middle a 1/2 point fee. And the green line on the bottom shows a 1% annual fee. So you can see how just relatively small differences can add up to tens of thousands of dollars over a 20-year period. So it's always good to look at fees no matter what type of financial product that you are trying to look at or compare. But this really emphasizes how fees can eat up your investment returns. All right, earlier we talked about money personalities, and we can curb some of our human tendencies to be reactive or to make more impulsive decisions by identifying specific things that we can avoid. So, avoiding trends, avoiding short-term trading, or reacting to the market volatility we might see when something happens can really help you grow your investments. So, if you find out about something that you do want to invest in because of a trend, it's important and very critical to do your research before jumping in head first. We're not saying don't pay attention to this at all, because these are tools to use, but there are definitely things that you want to avoid, especially reactive decision making based on the fear of missing out or market volatility in particular. And then the SEC, again, has a really valuable tool, a whole set of financial planning tools. But the one that we like to highlight the most is the compound interest calculator, which allows investors to see how their money can grow over time. So it lets you plug in an initial investment amount. Maybe it's $5,000. Maybe it's $500. Maybe it's $20,000. Plus the amount you plan to contribute periodically. So that may be $75 a month, right? That's what we talked about earlier. Then you can plug in the interest rate that you expect to earn. So for context, we've been using a 7% return in most of our examples when we're talking about compounding returns, but the average stock market return for the past 30 years has been about 10% if you buy and hold your investments. If you make a lot of moves with them, it's a little more difficult to kind of estimate an average. So that's another really great tool for you to use. And I'm going to hand it over to Anne to talk about ways of protecting your assets from fraud.
Thank you, Andrea. So, when you are investing, there are a few important concepts that you need to keep in mind to protect yourself, because fraudsters and scam artists are working very hard to separate you from your hard-earned money. There are a lot of different ways that they can go about doing that, and we'll talk about a few of the common investment scams next. The other thing I do want to just put a plug in for is investor.gov. It's the SEC's investor-facing website. It has a just huge amount of information on current trends, what types of scams are coming up. There will be alerts that pop up on the latest scams. And so it's a really good website to check out, not just for the tools that Andrew just went over, but also for what's coming up in investor fraud and what we're seeing. So please check it out often. So on red flags of investing and investor fraud, really, when you hear about an investment that is promising you a high return with little to no risk, Remember the chart. In investing, the potential for higher returns typically come with higher risks. So it's a red flag when someone claims big results, no risk, anything that sounds too good to be true, it probably is. The same thing with high pressure. Generally, in investing, take your time. Nothing is going to come up and only be available for the next 2 hours. Anybody trying to tell you that you have to make a decision hastily is probably trying to separate you from your hard-earned money. So be very careful. Don't let yourself be pressured. Take your time to investigate, do your research, and think about it before you take any steps, especially with big investment decisions. Another thing, lack of documentation. This is huge. Investments need to provide you with information so that you can tell how your money is being used, what else it can be used for, what the risks are. All of those things should be provided to you. And if someone offers you an investment that doesn't have any documentation or has only really scant documentation, watch out. Be very, very careful. All right, so why don't we go over a few of the different types of scams that we tend to see a lot of. I'm going to probably not have time to go through every single one of these, so I'm going to pick a few out. But for example, microcap fraud. This is fraud involving microcap, or what are called penny stocks. These are stocks that are generally below $5, but many times they're fractions of a cent. And it's much easier to manipulate financials for a lot of those securities because they may not be filing all of their financial statements with the commission the way that some more established companies are. Ponzi schemes, this is an old scheme in which promoters will continue to promote investments, taking in new investor money in order to pay the promised returns to old investors. The older investors are happy. They may provide testimonials stating that they've been getting X% as a return, but they haven't gotten their principal back, and that's because their principal is gone. It's been used to pay the previous wave of investors. Pump and dump schemes where a promoter will really hype up a stock through a variety of means. It could be through social media, it could be through direct messages, it could be through a series of press releases. And what they want investors to basically buy in as they're pumping up the stock so that they can dump their shares, and then the investors who bought in are left holding the bag. Affinity fraud, this is fraud against groups. Again, this is really something that we tend to see a lot of, where someone preys on a commonality that you have with them, whether it's you're from the same neighborhood, the same state, the same religious group, from the same university, you're both former military, anything that you have in common, and they prey upon that in order to separate you from your hard-earned money. So why don't we move on? So let's talk a little bit more about Ponzi schemes. Ponzi schemes, it's an old fraud, and at first glance, it may look like a legitimate investment, but the hallmark of a Ponzi scheme is that it tends to promise unrealistically high or unrealistically consistent returns, meaning they will promise a guaranteed 10% every month, or 30% every year. As I said earlier, the scammers using your money, the money from the newer investors, to pay those promised returns to the earlier investors, and may or may not actually be investing anything in an actual venture. One hallmark here is they tend to be very secretive. They tend to claim that they have a complex strategy in order to generate returns. But when you ask any questions, generally aren't willing to tell you what that strategy really is. The sellers and the investments themselves are often unregistered. So that's another way to check out whether or not it's a legitimate investment. Next slide. Relationship investment scams. Again, this is another one. There is an entire section on investor.gov. There's a recent series of alerts from both FINRA and the SEC about relationship investment scams because this is happening a lot. But think of these as like the text messages that you get out of the blue from someone you don't know who either just sends you a greeting like hello or seems to be confusing you for someone else. While it may seem like it's an accidental communication, instead, it's a very deliberate effort to engage you in communication as just a pretext to get you to start talking, and then will eventually, could be over a very long period of time, weeks, months, ask you to invest in a new or cutting edge investment, or that they have a really good deal to talk to you about because you're their good friend, they're going to let you in on the ground floor. Unfortunately, from a lot of recent investigative reporting, the operators of this type of scam have been victims of human trafficking and have been forced into it. But general rule of thumb, do not reply to messages from people you don't know. Delete it. Don't engage. And then don't worry about being polite. Block them. And if it continues, report it.
So I just wanted to pop in and talk about something that's similar to romance scams, but it's not considered a scam. Economic abuse can happen in a lot of different types of relationships, but it's a type of abuse that typically occurs in romantic relationships. And it could be with someone you're dating, someone you're cohabitating with, or maybe you've been married to them for many years. Economic abuse involves one partner controlling the other partner's access to economic resources. So this may include limiting their access to money, controlling their spending, preventing them from working or taking over their investments, or preventing them from making progress towards goals like retirement, which often requires participation in an employer-sponsored retirement plan or contributing to an individual retirement account. There's also a lot of hiding of assets and money secrets in general, but this specific type of economic abuse can be very detrimental to people's overall well-being. So I just wanted to note that, and it's back to the Ann Show.
Thanks, Andrea. So all of us are human beings, but we all think that we would never fall for anything. So how is it that fraudsters really persuade people to give them their money? They feed on your emotions. So they may promise you wonderful, unrealistic returns. The prospect of a get rich quick scheme always triggers everybody to want to get money faster. Unfortunately, it's also one of the best tactics in a fraudster's arsenal. They also may try to tell you again, it's urgent. You have to do this now because I can only offer this to 5 people, 4 people. They want you to think that you don't have time to research an investment, or if you don't act quickly, you're going to miss out. They may try to get you to feel like you owe them something, such as giving you a free dinner or a free lunch seminar or some other enticement that makes you think like you're getting a deal. they'll waive their fees this time or give you some sort of incentive special rate that they're not going to give to anyone else. Because the hope is you'll feel obligated to make an investment with them out of just a sense of fairness. Another thing is letting you think that many other sophisticated, smart people have already invested with them. It might even be people that you know, or people whose names you've heard of, or that someone that you respect. That's not all true, first of all. But even if it is, it doesn't mean that the particular investment is right for you. And then the other thing that they do is they will claim fancy titles or specialized expertise. Again, another tactic just to make you think that they know more than you do and that you shouldn't stop and do your research and instead just trust them. Don't. Another thing that scammers do is they really prey on your fears. The fear that you're going to outlive your money, or that you're running out of money, or that you're behind other investors that are the same age as you are. It's really FOMO, the fear of missing out on the next big thing. The fear of appearing stupid or unintelligent. And sometimes, even though your spidey sense is going off, you don't want to ask a question because you're afraid that it might make you look like you don't know something. In investing, don't worry about that. Any question is a good question, and it's better to arm yourself with knowledge than worry about the fear of appearing unintelligent. And then the last one is really just falling behind our peers. And some people will make riskier investments than maybe are best for them or that they normally would agree to do because the scammer has made you feel like you are being left behind. You are falling behind everyone else. And again, it's just silly for you to even stop and think about this. They're always trying to make you feel afraid so that they can take your money instead of you getting to keep it. One thing to note too, and there's a wealth of information on investor.gov about imposter scams. We have seen government imposters. We've seen imposters where fraudsters will impersonate organizations or individuals that you might know. So this could be a legitimate investment professional, like a broker or an investment advisor, using their name, and even spoofing an email address to make you think that you should click on a link that goes to a website that is similar but not exactly the same. Don't click on links in emails that are unsolicited. Don't answer phone calls that are unsolicited, because with the use of AI, fraudsters have gotten a lot better at impersonating than they used to be. It used to be you could tell there were a lot of misspellings. The logo was not even close to what the real logo of a particular company would be, but it's gotten a lot better. And so impersonators really are trying to steal identities. They could misappropriate financial assets. Any communication that you receive, if it is coming from someone that you didn't reach out to, be very wary because it could be part of a scam. So how do you protect yourself in the face of all this? I'm not trying to scare everybody, just trying to arm you to protect yourselves. If something sounds too good to be true, trust your gut. It probably is too good to be true. You have the right to ask questions and make sure that all of your questions are answered. Don't let pressure keep you from asking a question or make you make a rash decision that maybe you aren't comfortable making. Take your time, research any investment, look at unbiased resources from sources that aren't trying to sell you something. I'm going to repeat it one more time. You probably get sick of me saying it, but investor.gov is a really good way to try to find some answers. It can also help you find questions that you want to ask before you make a decision on something. And remember that things are easy to fake. Testimonials can be faked. Addresses can be faked. Communications can be faked. So trust your gut. Another thing that is a good thing to do anytime you are considering an investment, even once a year or more often than that, take a look at your overall portfolio of investments and see if it's still on target, if it's still appropriate for you. And if not, think about what types of modifications you might want to make. These are a series of really good questions to ask yourself. Ask, what are my current goals? And are my current investments a good fit with those goals? What's the time frame for what I want to do with my money? And does that match how I'm currently allocating my assets? Think about your risk tolerance, especially all of us age every year. Think about, is your risk tolerance still the same now as it was when you initially made these particular investments? Is your asset allocation on target? Do you want to adjust that? Or do you want to think about adding a different asset class? And then if you have periodic regular investment amounts, as Andrea said, those are really a great way to just off the top, make yourself dollar cost average and keep investing. Is this the right amount? Should you increase it or should you decrease it? Again, another few things I think we've talked about a lot. We've thrown an awful lot at you today, but compound returns matter. One of our superpowers is time. So time is always a great thing to take advantage of while you have it. Diversify. Don't ever put all your eggs in one basket. Look at costs and fees. And when comparing two fairly equivalent investments, consider what the fees may change in terms of making those investments. Dollar cost average or invest regularly. And then please, if you don't remember anything else from the webinar, remember, if it seems too good to be true, it probably is. So trust your gut. Couple additional tools that are available on investor.gov. Make sure that you're dealing with a licensed or registered investment professional. Check out your investment firm or professional. All you have to do is type in a name on the box on the website. It will show you whether they are both licensed and registered. You can also see an individual's employment history, including which firms that they've worked for, how many years of experience they have, and if they seem to jump from firm to firm over and over again, which could be a red flag. You'll also be able to see important disclosures, including any customer complaints, any regulatory actions against them, anything like that. It's an easy step to do. I think a lot of us maybe forget to do it, but it's fast and easy and something that hopefully would be helpful to you anytime you're considering investing with someone. So, what types of things when you're looking at your investment professional or particular investments should you look out for? I think probably everybody's familiar with Jordan Belfort, the Wolf of Wall Street. If you looked him up right now through BrokerCheck or the link to BrokerCheck through investor.gov, you'd see that he has been barred from acting as a broker or an investment advisor. So this is what you will see if someone is not able to be an investment advisor or a broker any longer. Similarly, on the right side of your screen, there's an example from OTC Markets of a penny stock that has been completely defunct. You see a skull and crossbones. If you see a skull and crossbones, watch out, buyer beware. And I'll turn it back to Andrea.
Thank you so much, Anne. So there are so many different ways to learn about investing. You can use investor.gov, which we've mentioned several times, and we hope that you use that. There's a lot of tips to avoid fraud. There's the compound interest calculator. There's a lot of unbiased content related to investor research that you can use. You can also order different publications from investor.gov. We also have other webinars. We have Building, Protecting, and Leaving Your Nest Egg webinar that's uploaded to YouTube, as well as our Investing 101 from 2 weeks ago that's also already on YouTube. And we will also put this one on YouTube if you want to share it. And anyone that registered, we will send the recording to in hopefully next week, but it might be a couple weeks. And then we have several podcast episodes from Making Sense of Money, which the Student Money Management Center co-hosts with the Illinois Department of Financial and Professional Regulation. And you could also look into simulations like the stock market game or Market Watch's virtual stock exchange if you want to get a feel for how stock market works or investing works without actually investing money. So that simulations can be helpful for learning some of the basics there. In summary, we want you to remember all investments have risks. You want to know what your risk tolerance is so that you can avoid fads, fraud, and FOMO. And you want to evaluate regularly and modify your plan or your portfolio based on any shifts in your goals, your values, what access to income that you have, right? You got to do what is best for your overall financial well-being while still working towards those long-term and even shorter-term goals with saving. Our next webinar is next week on Wednesday. It's called Cover Your Assets, Protect Your Stuff with Insurance. We are partnering with the Illinois Department of Insurance on that particular webinar, and we are looking forward to it. We also have a post-webinar survey that you can give us some feedback on. I think the link we put in the chat might be from last year, so we probably need to update that. But you can use the QR code on your phone if you want to give us some feedback. And you can also watch previous webinars on YouTube, and we have the short URL in the chat as well. And I want to thank all of my webinar series collaborators.